Welcome to our reading on long-lived assets, including the implications for financial statements and ratios. Again, good news here. A lot of knowledge from your level 1 is going to be directly applicable. So let's start with our first learning outcome. Explain and evaluate capitalizing versus expensing of costs. So we can either capitalize costs, which means store them in the balance sheet, or expense, which means include them in the income statement in the year in which they're incurred. Now, of course, if we capitalize, we're going to store the cost in the balance sheet and then we're going to release it over time through the income statement. So by capitalization, you're essentially spreading cost over a number of income statements. Okay, so capitalizing, store the cost in the balance sheet and then spread that cost to the income statement over a number of periods of time. Now, the method of spreading the cost, of course, is depreciation for our property, plant and equipment, and it's amortization for our intangibles. Now, of course, the same amount actually is going to likely to hit the income statement, just in different periods. If you expense, bang, the full cost goes through in the year of expensing. If you capitalize, you're spreading costs over a number of years. Now, the general rule says we can capitalize if the cost will result in future economic benefits. Now, the reason for this is we're applying the matching concept. If by incurring this cost, it generates higher revenues or higher earnings over a number of periods, then we are obliged to apply the accrual concept and spread costs. So store the cost in the balance sheet, then release it to the income statement to match against the higher earnings it's helping us generate. So we are going to capitalize if there is a definite future economic benefit resulting from incurring this cost. We're going to have to expense if the number 1 is no economic benefit, future economic benefit relating to this cost, or number 2, the economic benefits are uncertain. Again, if they're uncertain, we take a prudent approach and we say, look, it's better to expense in the year incurred. Now let's have a look at a compare and contrast the two in terms of financial statements. If you capitalize, you're creating a balance sheet asset. So by default, the assets are going to be higher. So we are going to get higher assets than when we expense. If we expense, the full cost goes to the income statement, giving you lower net income. And if you've got lower net income, of course, lower retained earnings. So assets and equity will be higher under capitalization and lower under expensing. Net income. If we capitalize, of course, the idea is the cost is being stored in the balance sheet. Whereas if we expense, it's all going through the income statement in year 1. So you get a big hit on net income, much lower net income in the first year. If you capitalize, there might be either no effect on net income or maybe only 1 period of depreciation and amortization. So certainly net income is going to be higher under a capitalization process in the first year. But I always think of expensing as getting your medicine out of the way all in one go. Yes, it's bad in the year of expensing because the full cost passes through the income statement, but there's nothing remaining to go through in subsequent years. And therefore, in subsequent years, our net income will be higher under expensing. If we capitalize, we're still feeling the pain because we've been spreading that cost over the life of the asset. Now, of course, under capitalization, because you're spreading costs, you've got a much smoother income statement, much less volatility of earnings, and of course, volatility of earnings represents risk. Whenever we see volatility, we talk about risk. So, of course, therefore, our income variability and therefore the risk attached to our earnings will be lower under capitalizing. Whereas expensing, bang, the cost goes through this year, then nothing in subsequent years. Much more volatile pattern of earnings if we expense. ROA and ROE in the first year. Well, let's look at our ROA first of all, net income over total assets. Now, of course, what we're saying is if we capitalize, our assets go up, but also, relatively speaking, our net income is higher, okay, in the first year. Now, typically, what we're going to argue is that the numerator is going to dominate this relationship. In other words, they're both rising by the same amount, but typically net income is going to be a smaller figure than assets. So proportionally, net income increases by a bigger amount, and therefore the ratio is going to be higher under capitalization. Same for ROE, net income over equity. Well, of course, net income is relatively higher than expensing, and equity is too. They both increase by the same monetary amount, but again, proportionally, we'd expect net income to be increasing by a greater amount. So ROA and ROE are certainly going to be higher under capitalisation. What about in later years? Well, let's look at our ROA in later years, net income over assets. Now, our assets, of course, are higher if we capitalised, and in later years, net income, of course, is lower than expensing because we're still feeling the pain via depreciation. So ROE, of course, is certainly going to be lower, and ROA is going to be lower, but so is ROE, net income over equity. Again, equity, of course, is higher due to the capitalisation process up front, but net income is lower because we're still feeling the pain of depreciation. So notice, whilst you get a boost to ROA and ROE when in the first year, it does come at the expense of a lower return on assets and return on equity in subsequent periods. So good in the year of capitalisation, not so good thereafter. Debt ratio, so debt over assets and debt to equity, debt over stockholders' equity. Well, let's think about these. Debt, of course, is really unaffected by the capitalisation process, so our debt's not going to change. We know capitalisation gives you higher assets and higher equity, so of course our leverage ratios are going to be lower under capitalisation compared to expensing. Next little bit, impacts on the cash flow statement. So operating cash flows, cash flow from operations. Now, of course, if you capitalise, then essentially the expenditure is passing through cash flow from investing. Remember when we were looking at cash flow statements back at level 1 and we said, look, every time we buy and sell the infrastructure of the company, the PP&E, the intangibles, subsidiaries, etc., the cash flows pass through cash flow from investing. So when you capitalise, it's treated as an addition to your infrastructure, and therefore the cash flow passes through CFI, which means, therefore, relatively speaking, our CFO will be higher. Now, when we expense, typically the cash flows pass through CFO, meaning our CFO is lower. So, essentially, if you capitalise, CFO will be higher, but whereas if you expense, CFO will be lower. Now, of course, with CFI, the flip side is true. If you capitalise, the cash outflow, the expenditure has passed through CFI, giving you a lower CFI, whereas if you expensed, of course, it passed through CFO, giving you a higher CFI. Okay, so where does the cash flow go? Essentially, we're saying if you capitalise, the cash outflow passes through CFI. If you expense, the cash outflow passes through CFO. We've got a little bit on capitalising interest costs. So this is really looking at assets that you are constructing for yourself, held for use assets. So what the company is really doing here is constructing its own infrastructure. Now, what we're saying is, look, what happens if you borrow in order to fund the construction of your own infrastructure? Can that interest be counted as a cost of constructing the asset? Well, the basic rule is, yes, it can. Okay, so the idea is, essentially, that any interest incurred on debt to finance the project can be added to the cost of constructing the asset, but only interest earned during the construction phase. Once the asset is fully complete, any additional interest has to be expensed through the income statement as normal. Okay, so yeah, our objective is to accurately measure the asset's cost. Again, if you were to go out and buy an asset from a third party, they would charge you not only the cost of manufacturing, but all the other costs. So if they'd use debt to finance their manufacturing costs, they would charge you the interest on that debt. So therefore, when we construct our own assets, it's only fair that we can capitalise any interest on borrowings. Now again, we can use debt, any specific debt that was specifically raised to finance the construction of the asset. But also, if we have a general pool of debentures, a general pool of debt that is being used to finance the company, then we can capitalise that. Now, any debt that is specifically related to other projects or mortgage debts, etc., then that can't be included. It has to be project-specific debt and then any interest on a general pool of finance. Now, again, we can only capitalise the interest expense that is essentially on the construction costs themselves. Any interest on debt in excess of the construction cost has to be expensed through the income statement as per normal. So in other words, if you've incurred 2 million of cost to date, then you can capitalise the interest on 2 million of debt. Now, capitalised interest, of course, is deemed to be part of the asset that you're constructing. As a result, like all additions to our infrastructure, it passes through CFI. Now, typically under US GAAP, when we incur interest, it passes through CFO. So notice there is a change to the cash flow allocation when you capitalise interest on debt used in the construction process. So our CFI is now going to be lower, but it's going to boost our CFO. Now, once construction is completed, the capitalised interest is going to hit the income statement via depreciation. Let's imagine we've capitalised $10 million worth of interest during the construction phase of our asset. Now, by doing that, it means the carrying value in the balance sheet of our asset is $10 million higher. So when we depreciate the total cost of the asset, our depreciation is going to be higher because of the higher cost of the asset in the balance sheet. So it is going to hit the income statement, but it's going to hit the income statement as depreciation rather than interest. And of course, it's going to be spread over the life of the asset. Now, capitalising interest costs result in a higher interest coverage ratio. Let's think about interest coverage ratio. Interest coverage ratio, EBIT divided by interest. Now, if we capitalise, of course, our interest, then typically what we're saying is, during the construction phase itself, then our interest expense is going to be lower in the income statement, because some of the interest we're incurring is not hitting the income statement, it's being added to the cost of the asset that we're constructing. It's going straight into the balance sheet, so you get a lower interest expense, certainly during the construction phase. Now, many analysts reverse the effects of capitalised interest. Now again, especially the rating agencies that are rating our debt, they're not going to be fooled into looking at interest coverage as EBIT simply divided by the interest in the income statement. They're going to be interested in EBIT divided by your total interest, no matter where it is located, whether it's been capitalised and added to the balance sheet assets or gone through the income statement. So a lot of analysts, therefore, are going to reverse capitalised interest before they compute ratios. So let's have a look at our analyst adjustments. So first of all, we're going to add back the capitalised interest, remove it from the asset and put it back in the income statement. So we're putting it back in our income statement. Now, there's another implication though. We might actually find that depreciation is bigger because of capitalised interest in the past. In other words, assets that you constructed yourself that are now in use, their depreciation would be higher because you've capitalised interest on those in the construction phase. So we need to remove any depreciation caused by capitalised interest from earnings. So that's going to have a direct impact on our EBIT. Okay, so deduct capitalised interest net of related depreciation from fixed assets. So again, adjustments to fixed assets, we're essentially reducing them by the interest, but then we've got to adjust the depreciation. So the depreciation shouldn't include the depreciation of the interest element. A capitalised interest, of course, in the period is going to be added to CFI and removed from CFO. Remember, normal interest passes through cash flow from operations, capitalised interest passes through CFI. So if we want to reverse the process of capitalised interest, we'll now put that through CFO rather than CFI, giving us a higher CFI and a lower CFO. Then we can recalculate things like our interest coverage ratio. So when you look at interest coverage ratio now, your EBIT and your interest will have been affected. The interest, of course, you're adding any capitalised interest in the year. And your EBIT, you're going to add back any depreciation on previously capitalised interest. So on assets that were constructed or you constructed yourself in the past that you were now depreciating because they'd come into use. Again, remember their depreciation will be higher due to their capitalized interest. So when we look at the interest coverage ratio, two adjustments. We need to add back the additional depreciation due to the capitalized interest on the numerator, and we need to add capitalized interest on projects that we are currently constructing to our denominator. Remember the rule, you can only capitalize the interest during the construction phase. Once the asset comes into use, then after that, capitalized interest will pass, of course, through our income statement. Right, let's look at some intangible assets. Research and development is a nice one to look at. Research, of course, is pure research, all about discovering knowledge and putting forward our understanding and knowledge. Whereas development, well, development, you can see we've defined it here as involving the translation of research findings into a plan. Really, for our exam, think about it as turning the research into an actual physical product. So we're talking about product development here. Now, with R&D, IFRS and US GAAP are consistent on what you do with research. They say, look, it is too uncertain whether research will lead to higher future benefits, therefore we're going to take the prudent approach and we are simply going to expense research costs. So research costs are always expensed. Development of products, though, different approach under US GAAP and IFRS. US GAAP says development costs must always be expensed. IFRS says development costs can be expensed, but they may be capitalized if certain criteria are met. Now again, US GAAP is saying, look, it's uncertain whether developing a product will lead to higher earnings. You don't know if the product will be a success, and therefore they take a very prudent approach of expensing. IFRS says if certain criteria are met, development expenditure can be capitalized. Now, be aware, we are not going to be tested in our exam on what those criteria are. Broadly speaking, though, they look at, have you got the resources to complete the project and develop the product? Have you done market research to ensure that there is a demand for your product out there? Are you going to launch the product, etc.? In other words, the criteria under IFRS are all linked to trying to establish, will it lead to a profitable product launch? And if the answer is yes, then you can capitalize under IFRS. So there is a difference in development expenditure. Software development costs. Now, two types. We talk about software developed for sale, so third-party sales, and software developed for internal use within the company. Now, again, be aware there's a little bit of a difference here between IFRS and US GAAP. First of all, let's start off with our software developed for sale. There's no conflict between the two sets of accounting standards here. Both of them say any costs in establishing technological feasibility must be expensed. Any costs incurred after technological feasibility has been established may be essentially capitalized. Now, what does technological feasibility really mean? It means the software does what it was intended to do. Problem with that is very difficult for the auditors to establish, is the software technologically feasible or not. They're not really going to have the expertise. So there's a lot of subjectivity in really saying how has technological feasibility been established. So a little bit worried that essentially a firm may have capitalized software costs even though feasibility is yet to be established. Now, software developed for internal use, here's where we get a difference between IFRS and US GAAP. IFRS says exactly the same as software developed for sale, so it doesn't make any distinction. Any software in establishing technological feasibility you expense. After that has been established, we may capitalize. Whereas US GAAP, notice, for developed for sale, it says, look, expense until technological feasibility is established, capitalize thereafter. But for internal use, it says we can capitalize the entire amount of software development costs, including the costs involved in establishing technological feasibility. Now move on to look at depreciation methods. We're asked to explain and evaluate the depreciation methods, how they impact the financial statements and the ratios that we calculate. Now, three major methods that we need to be aware of for our exam: straight line, accelerated, and units of production. All three methods, and this is in our box here, our grey box, All three methods will result in the same depreciation hitting the income statement over the life of the asset. Therefore, all the three methods are really affecting the timing of depreciation. That's the key. Okay. Now, a straight line depreciation method is going to result in the same annual depreciation expense. So the same amount of depreciation is going to hit the income statement over each year of the asset's life. Often used for financial reporting purposes, especially under US GAAP. IFRS, we often find accelerated methods being used because under IFRS there is a requirement to match the depreciation methods to the earnings potential of the asset. Now what that means under IFRS is if you have an asset that generates high earnings in the earlier years and the earnings taper off as the asset asset ages, then you have to use an accelerated depreciation method. Now there are a number of accelerated depreciation methods, double declining balance, sum of the year's digits. The only one we'll be tested on is double declining balance. Now what an accelerated depreciation method will do is it will charge more depreciation in the earlier years of an asset, and as the asset ages, the depreciation will decline. Okay, so double declining is the method that we are going to use for depreciation. Units of production, well, that is just going to simply depreciate the asset according to how much of its total life we have used to date. It might be based on hours, it might be based on units produced, it might be based on miles driven, etc. So again, here are our three methods. Now, the depreciation that hits the income statement over the life of the asset is always the same. Always, the total depreciation, the cumulative depreciation over the life of the asset is cost minus salvage value. But as we said, under the three different methods, essentially it's affecting the timing of this amount. So let's have a look at straight line. In order to calculate the depreciation expense, take the historic cost, what we paid to acquire the asset, plus any installation costs. Idea is we can include any cost in getting the asset into its location and working condition. Then subsequently, when we're incurring costs, unless it improves the earnings potential of the asset, the cost will have to be expensed. So cost minus salvage value divided by useful life, and that gives us our annual depreciation expense. Now, of course, note the two massive assumptions going in here, massive estimates, salvage value. How do we know what the asset will be scrapped for or sold for at the end of its useful economic life? It's a bit of a strokey beard meeting. $4,000. It's made up. Same with useful economic life. How do we know how long we'll use an asset for at the outset of the asset's life? We don't. It's an estimate. So be aware that depreciation by its very nature is going to be subjective. Now let's turn our attention to double declining balance. Here it takes cost minus accumulated depreciation at the start of the year. In other words, net book value at the start of each year. Now, of course, what that means is in year one, the net book value would simply be the cost you pay for the asset because you haven't got any accumulated depreciation at that point. So we take net book value coming forward from the previous year times 2 divided by the asset's useful economic life. This 2 here is why it's called double declining balance. There are other versions that don't use 2. There's a 1.5 version, 150 declining balance, 1.5, and that's used within MACRS, the Modified Accelerated Cost Recovery System used by the IRS in their official depreciation calculations. Now be aware, if you are going to calculate a double declining balance manually like this, you need to be very careful that you don't depreciate the asset below salvage value. Now remember, at the end of the asset's life, it should be depreciated down to salvage value. Then we scrap the asset, and if we receive salvage value, then when we de-recognise the asset from the balance sheet, there'll be no gain or loss in the income statement. So be careful if you're manually computing not to depreciate below salvage value. If you're using a calculator like the BA2 Plus, and of course if you look above the number 4, you can see DEPR, depreciation. Then if you're using double declining balance or using that functionality, then of course the calculator is smart enough to know to stop depreciating. Again, a calculator guide or calculator tutorial is available on the Swayzer portal. Units of production method, as we said, it starts off very much like straight line. In other words, this is the total amount that is going to hit the income statement via depreciation over the life of the asset, but then we're dividing it by, or multiplying by, the number of units used this year over the total capacity over the asset's life. Okay, so in other words, you're looking at the percentage of its total capacity that you've used in this current period, and you're bringing in depreciation in relation to that amount. Okay, quick little look at an example then. We've got a firm purchasing a new machine for $4,000. Estimated life, there is our estimated useful economic life for years, or 1,000 units of production. We'll need that for the units of production method. Salvage value, 3,500. So the total cumulative amount of depreciation hitting our income statement, the 4,000 units, less the salvage value of 500. So therefore 3,500 is going to be spread through the income statement over this 4-year period. Okay, we're also told that the firm produces 400 units. So let's look at our depreciation methods under straight line, double declining balance, and units of production. So straight line, there you are, the 4,000 cost minus 500 salvage, 3,500, spread over 4 years, giving us a constant depreciation expense of £875 a year. Double declining balance, year one, of course, well, look, the net book value is simply equal to cost, 4,000. So 4,000 times 2 divided by 4, 2 over useful economic life of 4 years, gives us a depreciation expense of 2,000 in year one. Net book value at the start of year two, of course, cost 4,000, 2,000 accumulated depreciation from year one, so we've got a net book value of 2,000 coming forward. 2,000 times 2 over 4 gives us a depreciation of 1,000. And of course, net book value coming into year 3 would be the 4,000 minus 3,000 accumulated depreciation, etc. Now remember, with double declining balance, you must be careful to stop depreciating when the depreciation takes the value down to salvage. Okay? Remember, you don't want the balance sheet value to decline below $500, so you have to manually stop depreciating in that period. Units of production method, nice and straightforward, cost less salvage value, and then we're going to bring it in according to the proportion of the asset's life we've used. So we've used 400 units out of a total of 1,000 units life, so we've used 40% of the asset's value, so we're going to bring in 40% of the depreciation, which totals 1,400. Impact on financial statements. Now again, notice a couple of them have stars next to them, and wherever we've got a star, then we're saying early years or a growing firm, and I'll explain why in a second. Now the depreciation expense, of course, under straight line, constant depreciation expense. Under an accelerated method, more depreciation than straight line in the earlier years, but of course as the asset ages, the depreciation will come down, and at some point it will go below straight line depreciation. And that might give you nightmares from deferred tax in a level 1, remembering that being the cause of a lot of our deferred tax issues. Okay, now again, in the earlier years, therefore, of the asset's life, accelerated depreciation gives us a higher depreciation expense. We've said growing firm as well. If a firm continues to add to its fixed assets, it can keep the accelerated depreciation constantly higher than straight line depreciation. You only get that decline in the accelerating depreciation, essentially, if the rate of growth in your assets diminishes or even stops. Now again, therefore, look, under straight line, if you've got lower depreciation, you're going to get higher net income compared to accelerated. So we could argue that straight line is a more aggressive depreciation form than accelerated is. Your assets, of course, if there's less depreciation, you've got less accumulated depreciation, and therefore your assets are going to be higher under straight line. Under accelerated, more depreciation, more accumulated depreciation, lower asset value. Now remember, the carrying value of your long-lived assets is essentially historic cost, gross cost, less accumulated depreciation. Equity, higher under straight line, lower under accelerated. I always use the rule, look, link it to net income. If you've got higher net income, then by default, you've got higher equity, because higher net income means higher retained earnings. Likewise, therefore, lower net income gives us lower retained earnings and lower stockholders' equity. Return on assets, net income over assets. Okay, so our net income, of course, is higher under straight line, and our assets are higher under straight line. So we've got an impact on the numerator and the denominator. Again, what we're going to argue here is that the impact on the numerator is likely to proportionally dominate. So whilst we've got similar monetary amounts, the proportional impact on net income is going to be higher, meaning overall, straight line gives us a higher ratio and accelerated gives us a lower ratio. Return on equity, again, higher net income, and of course your equity is higher as well. Again, proportionally by the same amount, monetary by the same amounts, so proportionally net income is likely to increase by a bigger amount, giving you a higher ratio compared to a lower ratio. Turnover ratios, sales over fixed assets or sales over total assets. Well, again, of course, sales are unaffected, but your assets are going to be higher under straight line, higher assets, and of course, therefore, you're going to get a lower turnover ratio. Under accelerated, of course, because of the accelerated depreciation, there's more accumulated depreciation and the asset carrying values are lower. So lower asset values is going to give you a higher asset turnover. Cash flow. Again, this is depreciation. This is pure accounting treatment. There is no cash flow implications for depreciation. The cash flows are when you buy an asset, of course, and when you dispose of an asset. Now, some people say, well, what about depreciation saving you tax? Well, again, yes, it does, but not accounting depreciation. Tax authorities typically do not like accounting depreciation. There is too much subjectivity. Number one, you get to choose the method you use, accelerated versus straight line. Number two, you get to choose your estimates. The estimates being, of course, the salvage value and the useful economic life. So typically the tax authorities remove the accounting depreciation and replace it with their own official depreciation. In the US, that's called MACAs. It's essentially 150 declining balance. They tell you the life of the asset. They assume zero salvage values, so all subjectivity is removed. In the UK, they use something called capital allowances. Again, removing the subjectivity. Depreciation estimates. So what have we got? Now, of course, change your estimates. Three sources of actual estimate. The method, accelerated versus straight line, that is not deemed to be an accounting principle. It's deemed to be an accounting estimate. The estimated method that spreads the cost the best. So if you change the method or useful economic life or salvage value, you do not have to go back and restate prior years. All you need to do is make a note in the footnotes. Okay, so notice the change is going to be disclosed in the footnotes, and we apply the new method going forward. Now, of course, by changing our useful economic life or salvage value, so if we give a higher useful economic life, if we give a higher salvage value, we get lower depreciation. Easiest way of thinking about it is just looking at the straight line calculation, cost minus salvage value over useful economic life. Well, of course, salvage value gives you a smaller numerator, increased useful economic life, and of course, our depreciation has got to decline. So if the salvage value or useful economic life increases, the depreciation expense decreases. Now again, deemed to be accounting estimates, so there is no need to go back and restate prior years. Be careful with that, therefore. Okay, so it's a prospective rather than retrospective adjustments when you get changes to accounting estimates. We need to be so careful when we look at the footnote disclosure to pick up on this. So for example, if they've suddenly doubled the useful economic life, then depreciation is going to halve in the financial statements. And of course, that's going to have a dramatic boost to a company's earnings. So be very careful. Good. Impairments. Now, impairments, very, very important that we're strong on impairments. If depreciation had subjectivity in it, then impairments have huge volumes of subjectivity. And of course, the CFA Institute wants us to be aware of where is the subjectivity and assumption coming into a set of accounts, because of course we can always question it. Now our LOS here says, explain and evaluate the impact of impairments and revaluations on financial statements and ratios. Okay, now let's have a look at IFRS first of all. We need to annually assess our assets for impairment if there are any indications that an impairment has occurred, such as a decline in market value, such as a decline in the market overall that this asset is being used in, and maybe sales have declined, maybe declines in physical condition of the actual asset itself. Now, we have an impairment under IFRS when book value, now again, book value, carrying value, whatever they call it, it just simply means balance sheet value. So book value, which of course for our tangibles is historic cost less accumulated depreciation, typically. So when our book value is greater than the recoverable amount, then we have an impairment. Now, next question, the thing you need to know for the exam, is what is recoverable amount under IFRS? Well, it's the greater of two things. Fair value. Now, fair value, if you like, is the market value, the sales value you think you could get for this asset. So fair value less any selling costs. Now, be careful, because in a minute, we're going to see US GAAP also uses fair value, but it doesn't deduct selling costs. So here's one of those points that you really got to remember the differences between IFRS and US GAAP. IFRS does deduct selling costs from fair value, US GAAP doesn't. Okay, so fair value minus selling costs. Now again, if the asset is traded in a liquid secondary market, that might be relatively easy to establish. But then, remember, it's the greater of fair value less selling cost and value in use. This is the value that you get from using the asset within your business. And they say, well, that is the value of the cash flows that the asset is likely to generate during its life and on disposal, discounted back to today's date. Well, hang on a second. How on earth do we know what the cash flows an asset will generate during its life and disposal are? We pick up our crystal ball and have some kind of moment where we suddenly understand the future. And whilst we're working out what the cash flows will be that our asset will generate over its life and disposal, we may as well ask for the lottery numbers as well. So, what I'm really saying is that value in use number, highly subjective, made up, if you like. Okay, now, if we decide that there is an impairment, then IFRS writes the asset down to the recoverable amount. So we reduce the balance sheet value down to the recoverable amount. The other side appears as a large expense, rather like a giant depreciation expense. Typically, we'll put it in unusual or infrequent items, in particular if it's material. So it's going to reduce your earnings in the year of impairment. Now, IFRS, as we mentioned before, typical rules are IFRS does allow you to reverse impairments, US GAAP does not. Now there is an exception to that rule. IFRS does not allow you to reverse impairments on goodwill and impairments as well on equity accounted investments. But most other impairments, IFRS does allow you to reverse. IFRS focuses on essentially economic substance. The argument being, if essentially the fair value or the recoverable amount has increased, it's only fair that we can reflect this economic substance in the accounts. Remember, US GAAP gets a bit hung up on this being abused, which of course it could be. And of course, by impairing an asset and then reversing that impairment, you're shifting profit from the year of impairment into the year of reversal. So US GAAP prevents that, rather trying to focus on stopping the earnings management. So US GAAP, two-step process for your impairments. Number one, identification. Number two, measurement. Now, to identify whether there's been an impairment, we compare the book value, balance sheet value of the asset, to the undiscounted cash flows from the asset's use and disposal. And of course, if the undiscounted cash flows from use and disposal are lower than book value, then we have to move to step two. And step two is to measure the impairment, its loss recognition. Now, notice what we're going to do. We're going to compare the carrying value of the asset to the asset's fair value. Now again, notice the difference with IFRS. Here it says fair value, it does not mention selling costs. So we're going to compare it to fair value. If we don't know fair value, the fair value was there. If we don't know fair value, then we use the discounted value of future cash flows. Now that sounds rather like value in use per IFRS. The present value of the cash flows the asset is expected to generate over its use and life and disposal. Okay, now, two-step process therefore for US GAAP. Loss reversal, notice assets held for use, prohibited. So once you impair an asset under US GAAP, typically therefore you are not going to be able to reverse it. There is an exception, to every rule there's an exception, and that is assets held for sale. These are assets that were held for use that we've decided to dispose of. When an asset gets transferred into asset held for sale, we stop depreciating that asset, and essentially instead it's subject to annual impairment reviews, and they can be reversed, those impairments, under both US GAAP and IFRS. Right, impacts of impairments on the financial statements. In the balance sheet, it's going to reduce the asset. It's coming down, of course, from its carrying value to the recoverable amount, or fair value under US GAAP. So we're going to reduce the asset's value. So down comes the assets. Ooh, there's a good one. Deferred tax liabilities reduce as well. They do. Now again, that's probably sending shudders through you thinking of deferred tax, still having nightmares for it from level 1. Well, if you remember, deferred tax was caused by depreciation in the tax returns initially being greater than depreciation in the accounts, and then of course the deferred tax liability reversed when depreciation in tax returns was lower than that in the accounts. Now what an impairment does is it's rather like a massive amount of depreciation in the accounts. So it drives the depreciation in the accounts below the depreciation in the tax returns. Increases the depreciation in the accounts above the depreciation in the tax returns, and causes therefore deferred tax liabilities to reverse. Hey look, just no deferred tax liabilities reverse, that will do it. So assets and liabilities are coming down, and so too stockholders' equity. Well, of course, the impairment also affects the income statement. It's a large expense. It therefore reduces net income. It therefore, of course, reduces our retained earnings, and hence stockholders' equity. In the income statement, well, it's an unusual or infrequent item. It's going to decrease the current period's income. However, bad news in the current period, good news in future periods. So it can be used for earnings management. Why? Because in future periods, you've now got a lower carrying value of the asset in the balance sheet. And lower carrying value means less depreciation in future income statements. So there is a potential for earnings management. And we've got a big reading on that later on. So be aware, higher net income, of course, lower net income in the year of impairment, but higher net income in subsequent years via lower depreciation. Cash flow, unaffected. It's a non-cash item. And indeed, it has no tax implications as well. Look, impairments are so subjective. If you could save yourself tax by impairing assets, every company would impair assets when they needed to save a bit of cash. So, of course, impairments are not tax deductible. Disclosure, yes, we would want to see, number one, disclosure in the footnotes, but I want to see, whenever there's been an impairment, discussion in the management discussion analysis surrounding why has there been an impairment, and also the estimates they've used to compute that impairment. Impact on ratios, fixed asset and total asset turnover ratios. Well, look, sales over assets, of course. Sales unaffected. Your assets are going to suddenly drop. Remember, we said the impairment's like a massive depreciation charge. It reduces the carrying value of the assets. So assets go down, sales unaffected, and therefore asset turnover ratios are going to increase. Debt to equity ratios, debt, of course, unaffected really by impairments, but the impairment does impact on the income statement. It's an expense. It therefore gives you lower earnings, lower retained earnings, lower equity. And therefore, our leverage is going to climb, essentially, when we impair. ROE and ROA, typically, it's going to be bad news in the current year, good news in subsequent years. Remember our ROA, net income over assets. and ROE, net income over equity. Well, in the current year, you've got both a decrease in net income and a decrease in assets, of course. Now, what that essentially does is numerator is going to dominate proportionally, so it's going to drive your return on assets down. In subsequent years, you've got the lower assets, of course, but net income is going to be higher because there's less depreciation, and therefore you tend to find in future return on assets is higher. Same essentially when we look at stock return on equity. In the current year, when you do the impairment, a hit on both net income and equity. Again, numerator tends to dominate the relationship, driving ROE down. In subsequent years, net income is going to be higher because of the lower levels of depreciation, causing an improvement in your return on equity. Okay, impairments. It just says, well, look, be aware when we look at impairments, if you do spot a company that's impaired its assets, then past earnings have been overstated. Why? You've got an impairment because the carrying value, essentially, is greater than the asset's fair value. Fair value under US, of course, GAAP. Now, what that means is we've typically failed to depreciate our assets sufficiently, and that's why their carrying value is too high. Now, what that means, therefore, is depreciation in the past has been too low, and therefore previous year earnings have been too high. Now, again, look, yes, we should be aware that management has control over the timing, so certainly timing, but also the size of impairment losses. Look how subjective they were. IFRS looking at the greater of fair value and value in use being the present value of the cash flows that the asset generates during its life. US GAAP using a two-step process. First step, using undiscounted cash flows from the asset's use and disposal. Second step, using fair value if it can be established, but if not, using the equivalent of value in use, present value of the cash flows that the asset's going to generate. How do we know what these cash flows are? Huge amounts of subjectivity going into these computations. So yes, impairments involve judgment. We're worried that there could have been impairments that haven't been recorded. We're worried that maybe there have been impairments that are bigger than that have been recorded, or maybe the impairments that have been recorded are too great. Okay, so we're really significantly worried when we spot impairments. Certainly, we would need to maybe revise our earnings forecast if you spot impairments. Maybe an indication that the future is not so healthy for the company. Bit of asset revaluation. Now, asset revaluation is allowed under IFRS, not allowed under US GAAP. So our intangibles and our PPE under US GAAP, then we have to use depreciated historic cost. In other words, cost minus accumulated depreciation. Under IFRS, though, we have a choice. Either we use the historic cost approach, so historic cost less accumulated depreciation, just like US GAAP, but we also have a fair value election we can make. Now, in other words, we can record classes of assets at fair value rather than historic cost. Now, that means as the fair value of an asset fluctuates, we're going to get unrealized gains and losses. Now, let's take a scenario where revaluation takes the fair value below historic cost. Now, notice in the balance sheet, the asset is reduced to its fair market value. We can then take the amount below historic cost to the income statement. Okay, so let's just be careful. The amount below historic cost. Okay, it hits the income statement. Now, if in subsequent periods the fair market value of the asset recovers, goes above historic cost, then we can reverse the amount of the loss that had gone through the income statement. So let's take the scenario. Let's say we bought an asset at 80 million. Let's say pounds, 80 million. Let's say it declined down to 60 million and then recovered up to 100 million. Right, okay, so 80 down to 60, then back up to 100 million. Now, how how does this actually work? Well, what we've got is we go initially below historic cost. And that means we've got a 20 million loss that is going to hit the income statement. Now, that's a loss, an expense, if you like, hitting the income statement in that second year. In the second year, notice it recovers, and in fact it does more than recover. So essentially what we're going to do is we're going to have our 20 million, our previous loss, that essentially we're going to reverse. So we can put essentially 20 million through the income statement as a gain, and the additional 20 million from 80 up to 100 million goes not to the income statement but goes to other comprehensive income that is a component of stockholders' equity. So when reversing any essentially revaluation losses, you can only reverse the loss that's gone through the income statement through the income statement. Any additional amounts get taken direct to other comprehensive income, a component of stockholders' equity. And that's what we're saying. Look, revaluation's above carrying value. So you bought the asset for 80 million, it's gone up to 100 million. Of course, the asset value in the balance sheet goes up by 20 million. We keep the balance sheet balancing by taking 20 million direct to OCI, other comprehensive income. Very similar to available for sale securities that we're going to see later on. Revaluation impacts. If we revalue our assets, well, again, assuming values are increasing over time, we're going to get higher assets and higher stockholders' equity. Now, because remember, upward revaluation, the gains above, the unrealized gains above historic cost will pass through other comprehensive income, a component of stockholders' equity. So we're saying, look, debt unaffected, equity is going to be higher due to the unrealized gains, causing, of course, our leverage to be lower. So certainly a boost to our lower. Higher earnings, if reversing prior losses, yes, okay, so remember we can reverse prior losses that have gone through the income statement in subsequent income statements. However, if you do revalue, you're going to have a higher carrying value in the balance sheet and therefore more depreciation. So higher depreciation going through the income statement, and therefore there's an impact on earnings. So be aware that typically revaluations are actually going to affect earnings negatively via additional depreciation. Lower ROE and ROA in periods after the revaluation, yes, because again, net income over assets, ROA, we're saying, look, assets are higher because of the revaluation, net income is lower because of the depreciation, additional depreciation, causing our ratio to decline. Same with ROE, net income over equity. Equity is increased due to the other comprehensive income, the gains going to other comprehensive income. Net income declines due to the additional depreciation, driving your ratio down. So revaluations, not so good in subsequent periods. Be a little bit aware of that. Now again, if we're seeing impairments, we would like those impairments to be independent rather than assessed by the management. Again, an independent surveyor revaluing the property, for example, would give us a more confident feeling in the fair values that we're seeing than maybe the management's own opinion. So using fixed asset disclosures, we move on to relatively straightforward computations here. What we're going to do is use the fixed asset disclosure to work out how old the assets are, what their total life is, and therefore how long until they're replaced. What we're trying to do is spot firms with older inefficient assets. Older assets might be less efficient, might lead to lower earnings. Also, and I think this is the big one really when we talk about valuation at level 2, if we've got assets coming to the end of their lives, they're going to be needed to be replaced. And of course, that means large CapEx outflows and, of course, impacts therefore on free cash flow and firm valuation. So certainly, spotting major up-and-coming CapEx can be useful. But also inflated earnings. Of course, older assets means less depreciation in the financial statements, and therefore earnings may be overstated to a degree. So let's have a look at your calculations. This is what you're going to potentially be computing. And again, we'll take you through numerical examples in the class. So historic costs, sometimes simply referred to as gross cost, meaning we haven't deducted any accumulated depreciation. So historic cost is our historic purchase price over the annual depreciation expense, and of course that gives us roughly how many years worth of depreciation are going to be charged over the asset's life. Now straight away you might notice the limitations of these computations. We are assuming straight line depreciation, okay? We're assuming no salvage values, so zero salvage values, and also they're distorted by things like land, because land is not depreciated. Depreciation is all about spreading the cost of the asset over its life, and of course the life of a piece of land is really the life of the planet Earth, so typically we don't depreciate land. So in other words, these computations are going to be less useful if there are significant salvage values, significant amounts of land, or the firm maybe uses accelerated methods. So they are rough and ready, be aware of that. Okay, so estimated useful life, historic cost over the annual depreciation expense from the income statement. Estimated age, let's take the accumulated depreciation from the footnote disclosure over the annual depreciation passing through the income statement. And that is telling us, therefore, how many years have been charged to date. Now, if we want the estimated remaining life, we could take estimated useful life and deduct estimated age, and that will tell us how many years remaining. Now, of course, we can compute that from first principles by taking net PP&E, and our net PP&E is historic cost minus accumulated depreciation over the annual depreciation expense. Okay, and that will give us our remaining life. Okay, so we now move on to looking at leases. We're asked to explain and evaluate the impact of finance and operating leases on essentially our firm's financial statements, and of course on the ratios that we calculated. We're also asked to be a little bit aware of leasee accounting and leaseor accounting. Now leasee, of course, leasee is the person that actually borrows the asset and uses it in the business. Leaseor is the legal owner of the asset. So let's start with a very quick blast through advantages of leasing assets. Now what we're saying here is it's cheaper financing. What we're really saying is, look, the alternative to actually leasing an asset might be borrowing money and using those borrowed funds to actually purchase an asset yourself. You might well find that the interest rate implicit within a lease is lower than if you were to raise external funds, so it might be cheaper. Secondly, you don't need any down payment, unlike purchasing an asset where you have to be able to raise all of the funds up front. And also, essentially, the rate implicit within a lease is a fixed interest rate, whereas you might find when the firm comes to borrow money, they can only borrow at a floating rate. So essentially, it might give them the ability to lock into fixed debt rather than floating debt. Leases typically are going to have less restrictions than when a company issues debt securities itself, so we're going to have fewer covenants. And remember, we talk about affirmative covenants that force the company to comply, they must do something, and negative covenants, they must refrain from doing stuff. Less risk of obsolescence. Yes, obsolescence of the leased asset. Ultimately, you don't own it. At the end of the lease, typically, of course, it goes back to the leaseor. So it's the leaseor's risk, not the leasee's. Off-balance sheet financing, if it is accounted for as an operating lease. Now, most forms of off-balance sheet financing have been removed under US GAAP and IFRS. Operating leases here are one of the big forms of off-balance sheet financing that still exists. Here, we've got the use of an asset and we've got a commitment to make payments, but if we treat it as an operating lease, no asset will appear in our balance sheet, no liability will appear, even though we've got a commitment to make future payments under the terms of the operating lease. Very, very controversial. Notice as well potential tax advantages, and they talk about synthetic leases here. This is a lease that is structured so in your financial statements it appears as an operating lease, so no asset, no liability, but in your tax returns we do record an asset, and therefore there is a tax saving based on the depreciation of the asset. So essentially, it's got recognition in the tax returns, but not in the financial statements. That's a bit of a US phenomenon, the synthetic lease. Just be a bit aware of that. Right, finance versus operating leases. This is going to be our focus at level 2. Focus at level 2 is typically you've got a company with some operating leases and you're going to want to capitalize those leases before you calculate your ratios. So first of all, let's look at the criteria for a finance lease under US GAAP. So finance lease, capital lease essentially means the same thing. Use those phrases interchangeably in the exam. Now, US GAAP says anyone, not all of them, anyone of the 4 criteria. Number 1, legal title of the asset transfers from leaseor to leasee at the end. This is what we would describe in the UK as a hire purchase agreement. When you make your final payment under the terms of the lease, you become the legal owner of the asset. A bargain purchase option exists. This simply means the leasee can buy the asset below the asset's fair value at the end of the lease's terms. Point 3.4, point 3, essentially you're leasing the asset for 75% or more of its useful life. And point 4, the present value of the minimum lease payments is greater or equal to 90% of the fair value of the leased assets. IFRS doesn't have quantitative criteria like this. It simply talks about the rights and risks of ownership transferring essentially from the leaseor to the leasee. Now, of course, if we have a finance lease, then essentially what we're trying to do is we're trying to create the illusion that we've purchased an asset and we've used debt to finance that acquisition. So we're going to record an asset in the balance sheet, we're going to record a liability, a debt instrument in the balance sheet. And in fact, our debt instrument is going to need to be split between current liabilities, being next year's principal payment, and long-term liabilities, being principal payments falling due after more than 1 year. Now, first of all, we're going to create our asset at the lower of the asset's fair value or the present value of the lease payments. Now, okay, let's assume that the present value of the lease payments is lower than the fair value of the asset. So we would record the asset at the present value of the lease payments. We record an asset and a liability. Now, the fact that we record both the asset and the liability at the same values leads candidates to incorrectly believe that the asset and liability will always equal each other over the life of the lease. And that's simply not true. The only times the asset and liability equal each other is right at the start of the lease and right at the end of the lease. Right at the start of the lease, that'll either be the fair value of the asset or the present value of the lease payments, if that essentially is low. And right at the end, they'll both be 0. But during the life of the lease, they do not need to equal one another. Why? They've got their own double entry. Essentially, the asset is going to be depreciated down to 0 over time. Now again, be careful. Salvage value here will typically be 0 because the leasee doesn't own the asset. And the useful economic life, be careful. We need to use the number of years of the lease rather than the asset's useful economic life. So you might be told in a question that an asset has an 8-year life, but the lease is only 6 years. Well, of course, we'd have to depreciate that over 6 years in our accounts because that's how the period of use for us. The interest, the liability is going to be treated as a debt instrument. We're going to charge interest and we're going to deduct principal each period. So each year the liability will accrue some interest and essentially will pay off principal, and ultimately the liability will decline down to 0 over the life of the lease. So yes, let's treat our lease payments rather like amortizing debt instruments. So we're going to take our annual lease payment, part of it will be treated as interest, okay, and of course the interest element passes through cash flow from operations, and the remainder will be paying off principal and thus reducing the liability, and of course reducing a debt instrument, principal repayments, they will pass through CFF. Okay, let's have a look at the impact on financial statements of our finance versus operating lease. Now, of course, if we have a finance lease, we are recording an asset, we are recording a liability. So higher assets, higher liabilities. Under operating leases, of course, comparatively lower assets and liabilities because nothing is being shown under an operating lease. The only treatment under an operating lease is every time we have a rental payment, we reduce cash and we put the rental expense in our income statement. And that's it for operating leases. There's no balance sheet asset recognition, no balance sheet liability recognition. Now, under a finance lease, we typically get lower net income in the earlier years, but higher net income in the later years. Now, what's happening to net income? Under an operating lease, of course, we're seeing rental go through under an operating lease. So op leases, you've got rental. Under a finance lease, what have you got going through the income statement? Two things: the interest on the liability and the depreciation of the asset. And that, of course, is our finance leases. Now let's just start with total net income. Notice it says same and same. In other words, the total expense that passes through the income statement is identical under operating leases and finance leases over the life of the asset. But again, what we've got is a timing difference. What we'll typically find is the total expense under a finance lease is higher in the earlier years, giving us lower net income. In other words, depreciation and interest is greater than the rental expense, giving us lower net income. However, in later years, then we tend to find that the interest element will decline over time, giving us lower expense and therefore higher net income. Why does the interest element decline? Well, because as we pay off the liability, the balance sheet liability is going to shrink, and therefore the interest accruing on that liability is going to reduce. So, key point: same impact on the income statement in aggregate over the life of the leased asset. However, under a finance lease, we have more expense in the earlier years, less expense in the later years, and under an operating lease, then essentially the expense is constant over its life, being the rental expense. Cash flow from operations, really it's higher for a finance lease. This is where your big advantage of a finance lease, because the interest element is going to pass through CFO, but the principal element passes through CFF. Under an operating lease, the full rental expense is going to pass through our cash flow from operations. Notice, the total cash flow is exactly the same under both methods. It's the split between CFO and CFI that differs. Operating lease, full amount through CFO. Finance lease, we're going to split interest through CFI, principal through CFF, paying off debt. Implications on our ratios: asset turnover, sales over total assets. Well, sales, of course, are unaffected. Under a finance lease, we are recording an asset, so up goes our assets, and therefore asset turnover is going to be lower under a finance lease relative to an operating lease. Return on assets, net income over total assets. Well, again, let's have a look at net income over total assets. Net income over assets. Our assets are going to be higher under a finance lease because you've recorded the asset. Net income, remember, is slightly lower in the earlier years because depreciation and interest is bigger than the rental expense. So essentially we've got lower net income, higher assets. So under a finance lease, especially in the earlier years, we've got a lower return on assets. Same with return on equity, net income over equity. Again, equity is higher due to the recording of... well, actually, if we think about it, net income is essentially lower, why is net income lower? Because of the additional depreciation and interest being bigger than the rental expense, and that does actually mean that equity is going to be slightly lower via retained earnings. But again, look, we're expecting the income statement to be proportionally, the effect of the income statement to be proportionally bigger than the effect on equity, so therefore typically ROE is lower on a finance lease, certainly in the earlier years. Debt to assets, well, significance of course is we are going to be recording debt, so debt's going to go up and assets are going to go up by the same amount. Remember, we initially record the asset at the same amount, the present value of the lease payments. So both debt and assets are increasing by the same amount. But remember, assets equal liabilities plus equity. So proportionally, assets are a bigger figure than liabilities. What that means is, proportionally, you've got a bigger impact on debt than you do have on assets. So therefore, essentially, our leverage is going to increase. Debt to equity as well, debt goes up. Equity falls by a tiny bit, but debt goes up. Equity drops by a tiny little amount via retained earnings. So again, higher leverage ratios. So notice a finance lease, worsening of your asset turnover, worsening of return on assets, worsening of return on equity, worsening of your leverage ratios. Pretty bad news, finance leases versus operating leases. So no surprise, therefore, that when you look at a lot of companies' accounts, you'll see a lot of assets under operating leases. In particular, airlines. I like David Tweedy's quote about Leases, and his quote being that before he dies, he wants to look at a set of airline accounts and see aircraft in the balance sheet. And of course, those assets are missing because most aircraft are held under operating lease, so no recognition of the asset, no recognition of the liability. But you can betcha the providers of debt finance to airline industries are capitalizing those operating leases before they calculate their ratios. Lease disclosure, what are we going to see? Well, look, the analyst is going to use the lease disclosure to actually capitalize operating leases, and that's going to be our focus really at level 2. We'll use some of the lease disclosure, and that's what we're going to do in class to work out essentially what amounts to add to capitalize the operating leases. So what they need to disclose, both for operating leases and capital leases, are the lease payments for each of the next 5 years and aggregate lease payments beyond 5 years. Now, the significant is, for the capital lease, they have to show us all of those payments. They also need to show us the present value of those payments. That allows us to compute an internal rate of return, a discount rate if you like. We can then take that internal rate of return and then apply it to the cash flows listed for the operating leases to calculate a present value of the operating lease payments. Once we've got that, we can then put in an asset and a liability into our financial statements for the operating lease payments. Now, certainly that is discussed in this reading, and it's also discussed in a later reading in our synthesis of financial statements right at the end of FRA. Okay, yes, operating lease, lessor. I'm not so excited by lessor financial reporting, I have to say. We've been talking about lessee so far, but let's talk about lessor. If it's deemed to be an operating lease, then the asset remains in the lessor. Remember, the lessor owns the asset, the lessee essentially uses the asset. So, in other words, the leased asset remains in their balance sheets. They don't dispose of it, they don't de-recognise the asset. And essentially, there's no recognition of asset or liability. So all that essentially happens is every time they receive a rental payment, they record it as rental income in their income statement. And of course, they're going to be depreciating the asset over time and matching, of course, the depreciation against the rental income flowing in. So nice, dead straightforward. Now, what if it's a finance lease? Now, finance lease, we are going to have a lease receivable on the balance sheet. And this lease receivable essentially is going to be the cash flows that we are owed, if you like, by the leasee. However, what we are going to do is de-recognise the asset. So the asset can't remain in our balance sheet in our PP&E, so we are going to de-recognise that. Now, we're going to recognise lease payments as part interest revenue and part return of capital, essentially, here. Now, there are two different types of finance lease accounting for lessors: sales type lease and direct financing lease. A sales type lease, a company using a sales type lease has to be a dealer or seller or dealer, manufacturer, if you like, of the leased equipment. It just happens that they've leased it out rather than selling it they normally do. Then you can use sales type lease. Key point here is in the income statement, we're going to show a profit as if we disposed of the asset up front, sold the asset up front, and then the rest will be interest receivable. Direct financing lease. Here the company involved is a financing company. So a customer here has come to them and said, look, we want this asset, will you buy it and lease it to us? So the direct financing company has bought the asset and leased it to its customers. Here they're a financial intermediary. Okay, they're not a dealer or manufacturer of the equipment. Therefore, we're going to show no profit or loss up front. So we're not going to show a profit or loss when we dispose of the asset. Instead, we're going to show it all as interest receivable over the life of the lease. Now, the total amount of revenues that the firms recognise under sales type lease and direct financing are going to be identical. It's just that sales type lease is going to allow you to recognise a big chunk up front on disposal of the asset. Let's just take a look at that then. So here's a sales type lease. We are therefore a manufacturer or dealer of the leased equipment. Now, the present value of the lease payments, you can see, is going to be bigger than the carrying value of the leased asset. And therefore, we're going to show a sale at revenue, if you like, at the present value of the lease payments we're expecting to receive, and the cost of goods sold will be the carrying value of the assets, essentially, the balance sheet value of the asset we're disposing. So a profit is shown up front. We're also going to create an asset up front, being, of course, the present value of the payments that we're expecting from the leasee. Okay, so interest revenue. So I think we need to be aware, profit up front on disposal, and then the rest is going to be interest revenue recognised over the lease term. Okay, now the difference between the interest revenue and the payment we receive, of course, is going to reduce the lease receivable until the lease receivable drops to zero at the end of the term of the lease. Now, direct financing lease, here we ensure that the present value of the lease payments is equal to the carrying value of the leased asset. Look, upshot is therefore no gain or loss on derecognition of the asset at the start of the lease's life. So, no gross profit recognised at lease inception. Instead, it's all going to be interest revenue. So it does mean the interest revenue is going to be higher under a direct finance lease than a sales type lease. Remember, the total revenues are identical under both. Keys to our exam: capitalising versus expensing. Yes, I would have an awareness of this. Depreciation methods. Yes, be aware of the subjectivity in depreciation in typically the salvage values, the useful economic life, and also the methods. Impact of impairments. Yeah, a real biggie here. Again, focusing on the subjectivity that is going into impairments. And then finally, finance versus operating leases. Again, I think our focus here will be knowing that the operating lease is off balance sheet finance and being able to use the disclosures to capitalise an operating lease. And again, we're going to take you through that in class.